Today, we're going to review a lesser known tax strategy known as net unrealized appreciation, or NUA. This strategy can be used by people that work in corporate America and may have used their 401k to buy company stock, which is often offered to employees who work for publicly traded companies. While not always the best idea from a diversification and risk management standpoint, NUA can offer some beneficial tax advantages. NUA is the difference between the average price you bought the shares of company stock, also known as the cost basis, and the current market value of those shares. Typically, when you take a distribution from a retirement account, you have to pay ordinary income tax on that full amount. The IRS offers a provision in the tax code that allows for the NUA portion to be taxed at a more favorable and the lower capital gains tax rate when that company stock is sold. This election is only available when the employer stock is held inside a tax-deferred retirement account, like a 401k, and the stock is moved to a taxable investment account after a qualifying event. Let's talk about some of the pros and cons of this strategy. The first benefit is that depending on your tax situation, you could wind up owing much less in taxes by only paying capital gains rates on the NUA portion of employer stock. Another benefit is that if you have other assets in your 401k outside of employer stock, they can be rolled over into an IRA, avoiding any immediate tax implications. You also don't have to use the NUA strategy for all your company stock and can cherry pick shares that have a low cost basis. The big downside is that ordinary income tax must be paid immediately on the cost basis of the employer stock. If an employee has amounted a large position in the stock over many years of working, the cost basis could be a large figure, which could create a large tax liability. I mentioned this previously, but having a large concentrated position in one company stock can greatly increase your portfolio risk and put your retirement savings in jeopardy. See Enron. When determining if you should use this strategy, you'll have to weigh the tax benefits of the NUA strategy versus the portfolio risk of a concentrated position. Utilizing the NUA strategy is not for everyone and really makes sense when there is a significant appreciation in a company stock. It's best to contact your financial planner and tax advisor to see if it makes sense for you. Thanks for listening to this iThrive idea. Have a great day.